And I'm going to share my screen, and Sarah can tell me if it's working or not. And from the beginning. All right, Sarah, can you see it? Got Mortgage 101 in front of your face?
Yes, yes, yes.
That's the downside of working with 3 screens. You got to figure out which way, where's display is going to happen. So anyway, thank you. Appreciate it. Mortgage 101. Why do realtors need to know? Obviously, we deal with buyers all the time. We deal with sellers all the time. We receive offers. A buyer is pre-approved with such and such lender. What does pre-qual mean? What does pre-approved mean? Knowing the basics of mortgage will really help. Just like we did the credit class, knowing the basics of credit for clients is really helpful. So we can steer them in the right direction. So we can give them advice when it comes to being their advocate. Mortgage is the same thing. I know many of our agents either are currently mortgage brokers. I wouldn't say many. Some of our agents are mortgage brokers, as well as real estate agents. I did that for 4 years, where I did both. Some have a background in mortgage, which I think is a good thing to have a background in, meaning, do you know how the process works? Do you know what the difference between a mortgage broker and a mortgage banker or a mortgage lender? What is generally the process and timeline and so forth. So today we're covering again some of this HomeSmart prepared training on mortgaging. But really, it's our experience. It's like, what do we bring to the table? And we're the jack of all trades, if you will. We're the source of the source. We point our clients to attorneys. We point them to inspectors. We point them to lenders. And they always have questions. And of course, we're the trusted advocates to say, yeah, okay, here's what I know, and here's what you should watch out for. Okay. So we'll be breaking down the mortgage process and giving you the tools you need to understand the process, and of course, and explain it to our clients. The first part is learning it. Second part is being able to teach it or share it, because it increases our credibility. We provide value to our clients, and we become a better overall better agent. All right. All right, why do real estate agents need to know about mortgage? Of course, as a real estate agent, it is essential to have a good understanding of the mortgage process. The handbook, I sent out I'll send them out afterwards as well, is designed to provide you with the knowledge and resources.
Second row, please.
What was that? Well, I got you. Hold on.
Yeah.
I'm gonna mute y'all. There we go. All right. Designed to help knowledge and resources to help you, your clients through the mortgage process. So we're not mortgage lenders, but we are their first point of contact. Okay. So obviously you can see in the slide, we're going to cover the finding the right lender, understanding mortgages, what private mortgage insurance is, how it works, sort of the mortgage life cycle, what happens to a mortgage. A lot of people don't know how it gets sold and so forth. Understanding origination, processing, underwriting, and of course, what happens after closing. So our goal by the end of our time will be to have a better understanding of the process, so we can explain sort of what to expect to our customers, to our clients. All right, we'll divide this in 2 sections today. The first of these will be understanding the process, which is what we're doing next. Okay, things to consider when picking a lender. Obviously, we see on the screen: reputation, interest rates, fees, customer service, types of loans offered. This is a big one. I know a lot of listing agents will receive an offer from somebody that has a pre-approval or pre-qual from a letter that they don't know, from a lender they don't know. And they're concerned because they don't know how reliable that lender is. So reputation is a big deal. Obviously, interest rates to your customer. How much is this money going to cost them? The fees, of course, we'll cover that. How quick are they? Customer service, do they return phone calls? So choosing the right mortgage lender is an important step in the home buying process. And these are the factors your clients should consider. This is one of those things too, we run into it all the time with our agents. And of course, me personally, is if the buyer gets pre-approved with like a USAA or a Navy credit union, good lenders, but they're terrible about communicating with the agent about the process. And oftentimes you're like, what's going on? So it's something to think about. And they're typically slower, generally. Now that we've discussed how important it is to choose the right lender, let's discuss mortgage. We're going to start off today with a review of the mortgage life cycle and the basics of mortgages. First chapter will be broader overview, but later in our time together, we'll go over this in more depth. Okay. Lenders will consider your client's credit score as an indicator of their credit worthiness. The higher the credit score, the lower the risk, which is also a result in lower interest rate. Typically, you get the best rate, the higher score you get. Different mortgage types have different credit score requirements. The range for credit scores is 300 to 850. And during our credit scoring and credit understanding credit lunch and learn, we talked about typically you're going to be in that 720 to 850 range for the good rates. You're at 620 up for FHA. The lowest typically you can get a loan is 580 at the worst, and that's oftentimes with conditions. So just be aware of that. But lenders look at your credit score, and it's usually the 3 bureaus as well. All right. So I mentioned earlier there's a difference between pre-qual and pre-approval. Now, I'm sure most of you know the difference, but we know that a pre-qualification is basically the lender, the buyer or borrower has contacted the lender and said, hey, I make $100,000 a year. This is what I have for debts, and my blah, 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 blah is this. And then they typically may pull credit and say, yeah, based on your credit score and what you told me, you're pre-qualified to purchase at this price. A pre-approval, though, it means they've gone through pulled credit and actually pulled the credit report to see what kind of debt they have and verified income that they actually make what they said they'd make. And it counts as the right type of income and so forth, and they actually qualify for a loan. Obviously, a pre-approval is much stronger than a pre-qualification. So getting a borrower pre-approved is not a required step for the mortgage life cycle, but can be a beneficial tool, especially in a competitive market. If you're a listing agent and you get a pre-qualification letter versus a pre-approval letter, that pre-approval letter carries a lot more weight when it comes to how solid this client is. And for a buyer's agent, if your buyer's pre-approved, you're much more likely that this is going to be successful if the property checks out. The pre-qualification is just the simple fact that they've had a conversation based on what they've told. Now that we've discussed the difference between pre-qual and pre-approval, let's discuss the different types of mortgage loans. We did this on the previous training as well. Obviously, these are the most ones we deal with on a regular basis: FHA, VA, an adjustable rate. We don't see as many of those now, but they are available still. We're seeing some of that. We had the mortgage crisis in 08 and 09, where a lot of it was adjustable rates, where the rates would adjust to and buyers could or owners couldn't afford the property anymore. They still have them for certain instances. And we also have a thing we're doing now with buy downs, like a 2-1 buy down, where they adjust the rate up after a couple of years to the fixed rate for the rest remaining of the loan. Obviously, a fixed rate where it's the same interest rate for the life of the loan for 15 years or 30 years. USDA, which is a government funded or backed loan for mostly rural properties, but you'd be surprised on how many properties actually qualify for USDA. It has to do with population amount, location to population centers, and so forth. But there's maps for that under USDA. You can search maps and find out if a property qualifies. That's another zero down option for non-VA buyers. So, and their credit score and their loan to value or debt to income ratios are a little bit more flexible. Conventional loans, of course, is the standard where, typically you want your good credit, good income. Standard loans are conventional, but these are the 6 most common loans. As a real estate agent, it's important to have at least a broad understanding of the different types of mortgages. We said FHA, VA, adjustable rate, fixed rate, USDA, and conventional. So let's dive into the first. We'll do FHA first. Conventional loans are offered by private lenders such as here. Hold on here. Yep, that's right. Conventional loans are offered by private lenders such as banks, credit unions, and mortgage companies, and are not backed by any government agency. So when they say conventional, they don't. That's why there's additional mortgage insurance on things less than 20% down. But it is private institutions that provide the money for this. So it's private lenders, banks, credit unions, and mortgage companies, and there's no government protection for that first 20%. So the conventional loan. It's an excellent option for borrowers with a strong credit profile, a steady income, and the ability to make a larger down payment. Once again, 20% is where you avoid paying that mortgage insurance, the PMI they call it. It's available in a fixed rate or an adjustable rate varieties, and typically offered in 15 or 30 years. I've seen a lot recently where lenders will say, hey, we'll do a 22-year or a 28-year, especially in refinancing, where they'll offer to refinance a 30-year fixed loan that has 12 years left on it. They're willing to refinance the whole amount over a 12-year period. So there's some flexibility now, but most of them are 15 or 30, just for reference for what we're doing today. And of course, if the down payment is less than 20%, the borrower may be required, they're always required, to pay private mortgage insurance. All right. It's a separate payment. Another keynote here for us realtors and talking to our clients on this, the private mortgage insurance. We know that currently, until something changes, federal taxes allow us to write off our interest paid on our mortgages, so our mortgage interest deduction. So the payment amount we pay, the interest portion of that is tax deductible off our income at the end of the year on our taxes. Mortgage insurance is not tax deductible. So to keep aware of that if they're, debating put 15% down or 20% down, and they're looking at the mortgage insurance premium, it's almost better to put the 20% down to avoid having this non-tax deductible fee there. And of course, they lower the payment that way too. Okay. All right, next one, FHA says FHA loans are insured by the government, which we have. There's Fannie Mae, insures basically 20% to a lender. Lender still lends them money, but it's insured by the government saying, hey, we're going to cover that 20% down payment, if you will. Your risk is only 80% of the loan to value. So there's a little bit more flexibility. It says it's designed to help first-time homebuyers and those with low to moderate incomes. Now, I know a lot of people with a lot of high incomes still use FHA based on credit scores and so forth. The advantages, there's a low down payment required, as low as 3.5%. I heard a rumor the other day by a lender that they're bringing back the 1% down FHA loans. I bought my very first house back long time ago with a 1% down FHA loan. So it does work. And so that may be there, but for now it's 3.5% down. There's much more flexible credit requirements and competitive interest rates, which oftentimes you can find a pretty competitive interest rate. And your credit score can be not quite as stellar. Like I said before, sometimes down to 620, in some rare cases 580, based on other characteristics like payment history and so forth, income source. It allows borrowers to use gift funds or other sources of down payment assistance and requires borrowers to pay PMI. So once again, less than 20% on conventional loans, and on FHA, since it's less than 20%, they require, it's an MIP, it says PMI here, but it's the form of mortgage insurance that is required by the government, which is mortgage insurance protection, I think is what it's called. It's still a payment that's non-tax deductible again. And then there's ways on the conventional loan and the FHA loan that once the buyer's loan to value gets to 80% or better, they can either get an appraisal to have that removed or refinance to remove that PMI or MIP. All right, next one, VA loans. We're dealing with a lot of those, especially in military areas, those with retired veterans, those that have served in the past, or those in active military. These are great loans. Obviously, they're a different process around appraisals and so forth, but it's designed to help active duty military members, veterans, and their families purchase or refinance a home. So the advantages, of course, there's no down payment. The PMI says it's not required. That's kind of a misnomer, as some of you probably already know. and you don't pay a monthly mortgage insurance payment. You don't pay a PMI or MIP in a VA loan, but they do have a funding fee. So they add 2% of the loan amount to the loan itself. That's their form of mortgage insurance. It's front loaded onto the total amount of a loan. Even though it's not a monthly fee, it's still a fee being charged to cover that. And as veterans continue to use the VA loan, if they use it a second time, that fee goes up to 2.5%. A third time is up to 3%. And so it is a fee that's kind of hidden into the cost of doing VA, but there isn't a monthly fee, which is a good thing when it comes to the mortgage interest deduction. All of the payment, all the interest, I should say, is tax deductible. So it's now added to the payment versus a separate payment for mortgage insurance. Oftentimes it's competitive. They have pretty good rates on those, and the flexible credit. There really is the veteran eligible with their DD 214? Are they eligible? Do they have the right to get a VA loan? Good deal. Credit's much less important, and then can they pay the payment as well? And that's why a lot of times active military that don't make a lot of money, but they have a housing subsistence or a food budget, that will help them qualify to make the mortgage payment on this too. So it's pretty cool. It's a great opportunity. I know Sarah's doing that with working with the military and first responders. So okay. USD, I touched on this a little bit before. Obviously, the USD loan is designed to help low to moderate income borrowers in rural areas buy homes. Available to eligible borrowers who meet certain income and geographic requirements. No down payment requirements, flexible credit, and competitive interest. I found these to be very much like a conventional loan, except that for buyers that have little money and the credit's not so hot, be able to get into a house with zero down. Oftentimes they don't have the same restrictions as a VA appraiser. This is like a conventional USD appraiser as well. Not a bad option. Like I said, check into this if you have buyers that don't qualify or don't have the down payment for an FHA, and they're buying a property that isn't in a city center, but maybe a little bit on the outskirts or in a smaller suburb. Check into it. The maps are pretty generous on this, and they may qualify. Now, I will say this on this too, on the USDA loans, I've noticed that the interest rates are a little bit higher on these. They do have in most cases, a mortgage. They didn't talk about it here in the slides, but they do have some sort of mortgage insurance. And there's a little bit more costly fees, but it's an opportunity for them to get into a house with zero down payment. And the cool thing, they didn't cover it yet, but on the conventional, I believe a seller or agent can contribute to the buyer up to 3%. I think on FHA and VA, it's up to 6%. I'll have to verify that for you guys. USDA, I believe, also 6%, so they can get gifted, if you will, or credited up to. So it really makes it attractive for someone that wants to buy a house, can afford a house, but can't have the down payment or may not have the great credit. So fixed rate loans, obviously, we've seen this before. Most of the dependable ones, 30 years, are fixed rate. They don't adjust. I'll skip that. This is pretty much common. The adjustable rate, we touched this. Typically, there's it can change over typically a year. There's like a 3-year arm, a 5-year arm, a 7-year arm, and what that means basically is it adjusts yearly or every 3 years up based on the current interest rate plus something. There's a calculation involved where whatever the interest rate has risen to or lowered to, plus a basis point, if you will, that's where it adjusts to, and adjusts at the annual point there. So they can change periodically based on specific index. So it could be the treasury bonds, it could be interest rates, it could be whatever. It can be a good option for borrowers who plan to sell or refinance their home before it adjusts. So if they get a 3-year, 3-1 arm or whatever it is, where it's kind of fixed for the first 3 years, and they want to sell it 3 years from now, it may not be bad because they have a lower rate for the first 3 years. A 1-year arm adjusts every year, makes you go, oh, okay, it's a lot more risky. And of course, if they qualify for the lower rate and then the rate adjusts and they no longer can afford it, you're not putting your client in a very good position. So, all right, obviously, typically 15-year or 30-year, I talked about the differences between the two. If they want to pay it off sooner, 15 years, payments could be a little bit higher, or 30 years are the two most common. That you should look at this, the payoff though. The payoff for the same loan amount in 15 years, yes, the monthly payment's higher, but the amount of interest paid on 15 years versus 30 years is dramatic. They pay a lot less interest over time. Now, on a 30-year loan as well, and this is one of those things that if a buyer pays an extra payment a year towards the principal only, so they take the whole payment towards principal, they estimate it knocks off 7 years off your loan. So if you do that every year, so basically your 30-year loan ends up being what, 23 years instead. So it's not another way of dropping down the principal quicker is just doing an extra payment. There's also loan companies that will allow a buyer or borrower, I should say, do a bi-weekly or bi-monthly, split the payment in two and pay half at first of the month and another half middle of the month. That also accelerates more towards the principal. So it's an option to look at that some lenders offer. Okay. Two other types of loan programs are rate buydowns and balloon loans, if you will. We see this a lot now where some lenders or some builders are offering a buy down to the buyer's rate because the rates went up. They went dramatically from like 4% to 7%. Now we're seeing some kind of fluctuation in the interest rates. But some sellers and some builders are offering, hey, we'll buy down your loan for 2 years to make it easier for now and adjust into it. So the definitions here, of course, the rate buy down, borrower or third party pays additional fees or points upfront in exchange for a lower interest rate on loans. Typically what this does, you can buy it down for, like the 2-1 is buying down the first 2 years. And typically that's a point for each year. A point is 1% of the loan amount. And then sometimes you can buy it down for the entire loan. Of course, then there's more fees for that as well. Rate buy downs can be beneficial for borrowers who want to lower their monthly mortgage payments or who plan to sell the property before the temporary rate buy down period ends. However, it's important to consider the upfront cost of a rate buy down and whether the long-term savings will outweigh the initial investment. So even in a 2-1 buy down, let's say that the place is $500,000 for easy math's sake, and you wanted to buy it down by 2 points to get down 2 points to lower your payment. Let's say that's $5,000 to $10,000. 10,000 buys your rate down by 2 points on this loan, and let's say it drops your payment by $150, $200 a month. Over 2 years, how much are you saving? You're not saving enough to make up the difference of the cost to buy it down. So make sure that the return on your investment makes sense. Now, obviously, costs to purchase a house, buy down points, your mortgage interest deduction, all those things can be considered in with your accountant or their accountant as well. But sometimes it makes sense not to do it just because, okay, what is the actual gain for this? Now, the benefit of a balloon mortgage is that monthly payments during the initial term of a loan are often lower than it would be for a traditional mortgage. This can be beneficial for borrowers who anticipate an increase in income in the future or who plan to sell the property. Where I see balloon payments a lot is in like people trying to buy the property. They'll do a seller finance, for 2 years or 5 years, and they'll have a balloon payment come due at 5 years. So they'll say, I'll give you X amount for the property. We'll make payments for a certain amount of time. And they're trying to save up enough for a down payment, or they want to turn around and convert it and sell it or whatever. But there's some lenders too that will do, hey, I'll even payments for 5 years, and then the full amount comes due at this term. So it's amortized over 30, but in 5 years, the entire amount's due. So the buyer has to refinance or sell the property when that balloon, a ticking time bomb, comes along. So a lot of investors use this model that I've seen, or people trying to buy a property and build on it or something like that. But most of your traditional buyers buying residential property won't do this unless they have a plan of, moving on quickly. Oops. Okay. PMI, we talked about this. Your client may be required to pay private mortgage insurance when obtaining a mortgage loan. Once again, this is on your conventional loans, the PMI, because it's private lenders are loaning the money to your client and it's not government backed. So there's private mortgage insurance, a third party. And in some cases, to keep this in mind, your buyer may be pre-approved with the lender for the loan, but they also have to be approved for the PMI, the private mortgage insurance company. And I've seen this happen where the buyer was approved for the loan for their overlays of protection, but denied for PMI. And when they're denied for PMI, they can't get the loan. So be aware if you're putting less than 20% down on a conventional loan and they have to get PMI, they'll probably qualify, but they won't always qualify for PMI. So keep that in mind. And something to share with your client as well. Lenders typically require PMI when the borrower makes a down payment of less than 20% of the home's purchase price. This can be paid as a monthly premium, a one-time upfront premium, or a combination of both. So it's either a monthly payment or an upfront premium. It's important to note that PMI only protects the lender and does not protect the client. The cost of PMI varies depending on the size of the down payment and the loan amount and the borrower's credit score. So once again, they have to qualify for the PMI and the payment for PMI. Let's say you have 17% down, your PMI payment should be lower because you're only guaranteeing that 3% you're missing versus 5% down, you're guaranteeing a larger portion of it. Also, depending on your credit score. So if they have a low credit score, it's going to be higher, and you can see the purpose here. So, but it protects the lender. So if the buyer defaults on the loan, this ensures the lender of that potential loss there. It doesn't insure the buyer for any losses. And then of course, the cost varies. And you see in the notes here, it says the cost could be as low as 0.3% of a loan amount per year or as high as 1.5. So these are a range. But if the loan amount is 500,000, that's a big difference between the two. So. Okay, benefits, obviously, cancellation. So the benefit of PMI is allows the borrowers to buy a home with a smaller down payment, which can make home ownership more accessible. It also provides lenders with the added layer of protection so they can actually give the loan and to approve the loan. And then in most cases, I mentioned before, the borrower can qualify to cancel the PMI once they've paid off 78% of the loan or built up 20% equity in the home. So if they waited, as the average over the last 30 or 40 years is between 8 and 10%. So they wait probably 2 to 3 years, they're probably going to have equity in the home of 20%. Whereas what they owe on the property is 80% of what it's actually worth. Or they paid off 78% of the loan that they borrowed. Typically, they can get the PMI canceled. Most of the time, the lenders will require some kind of like appraisal to verify that. And sometimes they'll do an automated an AVM. It's a computerized model. So, but that's based on the loan terms with the lender they borrow from, but they may be able to cancel that, which means their loan doesn't change, but their payment to PMI goes away, which and in many cases may save them $100 to $200 a month. So the mortgage life cycle has many different stages, but all borrowers go through these 5 fundamental steps. For now, I'll give you a brief overview, but we'll discuss more as we go along. First, the borrowers will go through the loan origination. During this step, your client will complete their loan application, gather proper paperwork, and select the loan type. So is it FHA, USDA, conventional, and so forth. Then your client will go through the loan processing during the review of the loan. So that the processor will make sure they collect all the stuff that the underwriter is going to need. They're going to make sure, do we get the applications assigned? Is it accurate? Do we get the pay stubs? Do we get the W-2s? Do we get all of the items that are required to get approval? Oftentimes now lenders will use the automated underwriting approval software. So they'll get a printout of what's needed. So you're approved based on what you input in the computer, as long as you supply these things. There's a checklist, and the processor is the one that goes through that checklist and makes sure that the underwriter has all of these things when they review it. So then the application gets sent to underwriting. During this phase, an underwriter makes a decision on whether to approve or deny the loan. Now, this is one of those things where they can send it back to the processor as well. If they can't approve it here, typically we're doing automated approval. So this process is pretty straightforward. They're just checking the boxes, making sure they have all of the documents that the automated approval said they needed, and then they put their rubber stamp on it. Other times, though, when they're not automated approve and they do a manual underwrite, this is where a human person will go through and evaluate all the documents, pay stubs and so forth, and say, man, make a credit decision. So that's possible as well. Underwriting is a very big deal because they're trying to weigh the risk of lending the loan or not lending the loan and being able to resell it after the loan has been made. If the loan application is approved, then the loan moves forward to closing. This is where we get closing and funding, right? During this stage, your client will sign the loan documents and transfer the title. So they're saying, all right, title's going into the buyer's name. We're putting a lien against it with the mortgage. Money's being transferred, so paying off any existing liens and so forth. This is our typical closing for us as realtors and the borrower. Then lastly, it goes into servicing. During this stage, your client will make monthly payments to the lender or servicer. We saw this a lot more in the past. There's a lot more lenders now keeping the loan and the buyers paying their payments to the loan lender that made the loan to them. But oftentimes they'll have a lender will make the loan, approve the loan, and then they'll sell the loan to another servicer. And then the buyer gets a notice in the mail saying, hey, your new loan servicer, now the new owner of your loan is now Wells Fargo. Please make your payments going forward to Wells Fargo. That's servicing. How we doing on time? All right. I'm running late. Okay. All right. All borrowers must go through the 5 steps we just discussed, but there are 2 additional stages borrowers may find themselves in. The first of these stages is refinancing. As we know, mortgage rates are volatile. Because of this, borrowers may decide to try to refinance their mortgage loan. Once borrowers complete their refinancing process, they may be locked into the rate for a certain amount of time before they can refinance again. Not typically, but it may not make financial sense to refinance soon because it costs money to refinance. And unfortunately, a borrower may not be able to make the mortgage payments. And if this occurs, the borrower may have to go through foreclosure. During this, the property gets sold to help pay off the outstanding mortgage debt. And then lastly, transition. Now that we've gone through the steps of the mortgage, let's discuss the key player in the process that we end up this thing today. So quickly, we know the buyer, that's who we're applying for the loan. The mortgage broker, that's the person typically that is finding them the right loan. That's taking the application, that's giving them the best options, and then they're sending it over to the lender. Now, they may work directly with the lender and skip the mortgage broker process, but typically this is what happens. The lender is the one that actually provides the loan to the borrower, and the loan officer is typically the ones that are working for the lender. So you have a mortgage broker, loan officer. If you're working with a mortgage broker, they're probably working on behalf of multiple companies, and they're shopping for the best rate and best terms for your client. If you're working with a loan officer, typically they're working with one lender and doing the same thing, but providing the application and get into the lenders. Make sure who they're working with does matter. My experience on this, by the way, Sarah and everybody else, is that traditionally I work both. I work for a lender as a lender and loan officer, and I've worked as a mortgage broker. I found that on a mortgage broker, I could offer better rates, but my fees were all third-party fees and tended to be higher. As a loan officer for a mortgage lender, oftentimes my interest rates would be higher. I couldn't offer lower rates, but all the fees were kind of included in the rate. So they're not the same thing. Compare. It's not always about rate. It's how much is this loan going to cost my customer, and compare the two. Because oftentimes when you compare the rate and the fees, it may be better to go to the loan officer. Who knows? All right, skip this one. Obviously, this is part of the process. The loan processor, the appraiser who appraises the property. Now, appraisal system has changed over the last several years as well, where there's lenders used to have their own appraisers. They used to go to a company that kind of lobbied them. They used whoever they brought them donuts, if you will. Now they go into it's a third-party system and it's random. Whoever's next up in the poll gets the appraisal call for that property. So, and appraisers are qualified for conventional, some are qualified for VA and so forth. So appraiser, they're licensed in the state of Texas to do appraisals. There is different levels of appraisers for different types of property as well. I won't go into that today. Oops. Sorry, guys. Underwriter, we talk about this. They represent the lender and they make a credit decision. Obviously, the closer, that's the agent that helps the third party and escrow that helps us transition, pay off, extend original liens, add a new lien, transfer title, and so forth. All right. Make this quickly. The mortgage cycle, quickly. The loan origination is when they make an application. That's as simple as it can be. You make application, step one, step two. Your buyer has providing all these documents to them. We know that they have to pick the type of loan they want. This is where they all to the lender. They've got to provide, fill out the application. The lender has to give disclosures. They have to provide income and assets, and the lender pulls a credit check. This is called a hard pull. This will show up on your credit report as a hard pull. They pull all three bureaus. There is a rule around if you shop lenders and they all pull, it will affect the borrower's credit score temporarily, because the credit bureaus will see all the mortgage application credit pulls in a certain period, I think it's 30 days, as one pull eventually. So it will adjust accordingly, but it does affect. If they're on the border of being barely qualifying, make sure you're working with one lender. They only pull the credit once, because that will affect them and drop them below the score. All right, process, and we talked about this. And their goal is to collect documents, order the appraisal, review the title, package the loans up, and submit it to underwriting so they can make a credit decision. Underwriting, we talked about this as well. This is where they review all the things that have been prepared, the approvals, the documents, make sure it all checks out, and then they make a credit decision. Are they going to loan this borrower money on this property? This is after the appraisal comes in, after all the data is there. All right. So underwriter evaluates the application, they make a decision, and if they grant it, then they send a loan. They basically a notice of approval, if you will, to the loan. Quickly on this one, we're running late. We covered this in our credit course, but there are the 4 C's of credit. There's, credit, capacity, collateral, and capital. Do they have the money to the down payment? Do they have the credit and past history to make the payments on time? Are they credit worthy? Do they have this property? Is it valued enough to have collateral to justify the loan? Did it appraise for the value that you're borrowing? And capacity, does the buyer have the income, the stream to pay the loan off? Loan to value ratios. We got to spend a little bit of time on this one too. This is a big one too, because lenders have mandated federal loan guidelines on loan to value and debt to income ratio. These are ratios they look at when they're looking to approve a mortgage for a borrower, and of course housing. So loan to value measures the amount of money borrowed through a loan in relation to the appraised value of the asset being financed. Most lenders require a loan to value less than 80% to avoid PMI. So if the property, you're buying it for 500 and it appraises for 500, great. Yeah, if it appraises for 400, we got a problem, right? Loan to value is the amount of loan divided by the appraised value. DTI is used to evaluate the borrower's ability to manage their debt and make payments on time. Lenders typically consider less than 36% good and greater than 43% is too high or bad. So 36 and 43, some books will have 36 and 41, depending on which lender you're dealing with. This is like, based on what your borrower makes, gross amount, 36% of that can go towards mortgage, if that makes sense. And then 43, if you will, can go towards all the debt combined, all their payments monthly combined. So DTI is total monthly debt payments divided by gross monthly income. So then housing expense measures the percentage of the borrower's gross income that goes towards paying for the housing expense. Lenders typically view less than 28% as good and greater than 36 as too high. So again, a range. So housing only, how much of their gross monthly pay that they get from their job goes towards their mortgage only is a range between 28 and 36. So good to not so good. And then the other range, 36 to 43, is that range for total debt. So I can say it correctly. So those are the numbers they look at. And then, of course, transition. There we go. So once the underwriter finishes evaluating the credit application and their DTI and the loan to value, they can either approve or deny. Deny that the loan application is not approved. Conditional approval, they'll say, I approve it if you can provide proof of X. So the borrower has been approved for a loan, but must meet certain conditions before the loan can be funded. These conditions may include providing additional documentation, paying off certain debts, or meeting other financial requirements. I've seen conditional approvals where they had to pay off a car loan. There's like 4 payments left and they had to pay it off. I've seen conditional approvals where they had to get something. Anyway, the idea here is you're approved if you do these things. And then approval, of course, is like we've approved you, you're good to go based on all the things checked off, your debt to income, loan to value, appraisal, the property appraised, and your credit approved, go buy the house. Closing, obviously, we know what this is. Once they've sent over the funding, which is what the lender does, the lender says, we're closed on the loan, we're funding the loan, we're sending money to the escrow department. Escrow then, of course, pays off existing liens, transfers title into the buyer's name, and then you have closing. Closing for us as realtors is when it's been recorded and the title's been transferred and funding's happened. Closing for a lender is when they funded the loan. And so sometimes that's confusing for a borrower when the lender said, hey, we've closed. What they're saying is we funded the loan. Now we're waiting on escrow to finish the process to close the transaction. All right. And we know closing is escrow is directed by our escrow instructions. They review the loan documents, they review the contract documents, they make sure that all the parties involved are in agreement before they proceed in transferring and dispersing funds to all parties. Here's the graphic again about the loan origination, appraisal fees, title insurance fees, home inspection fees, escrow fees. These are common costs a buyer pays. They pay the origination, typically it's 1% of the loan amount. They pay the appraisal typically up front. They pay their portion of the title insurance fees typically. There's 2 title insurance. There's one to insure the lender and one to insure the seller provides it, if you will, for the borrower. There's the home inspection fees, but the buyer pays that to make sure they're buying the property and it's in a condition they expect. They have all the knowledge before them. Their half of the escrow fees to have that third party process the transaction. And of course, recording and any attorney's fees are pretty common, but a borrower should be aware that there are upfront costs, earnest money, option money, down payment money to be aware of, but these additional fees that are going to come into play to consider when they're buying a home and getting a loan. All right, now after the buyer has closed on their loan, it will proceed to loan servicing. So will the lender keep the loan or will they sell it to another secondary market and the transfer it? So here's the mortgage servicing. They have loan set up, they start collecting payments, they escrow management, they have a set aside separate account for your buyer for their taxes and their insurance. They have a duty to give records keepings to your client and to the lender. They have a customer service obligation, loan modifications in the event they want to do something like that, deal with delinquent accounts and investor reporting. Those are different things that the servicer does, but it happens after they get the loan, and this is what happens behind the scenes. That's why it's either sold or kept, and then what they do from there. And lastly, we're almost done here. They have options. You know, we talked about this. They can refinance at just about any point in time if it makes financial sense. And of course, if they don't make the payments, there is the option or the unlikelihood or the detrimental action of foreclosure, which is the lender's right to foreclose on the property. All right, quickly, I went through this a little long, as we always do, it seems like. By understanding the mortgage process and the options available to your clients, you can help them make informed decisions and navigate the process successfully. I'll send out the slide deck and the handbook so you can give it to your buyers. But finding the right buyer, understanding mortgages, what PMI is, what the life cycle of a mortgage is, understanding the process of origination, processing, and then underwriting, and then what happens to the borrower's loan after it closes. All right, I'm going to stop this now. And this, I'm gonna, over here, I'm going to stop and hold on, stop share. Okay, that was a lot, but and many of you know about mortgages already. But if we can show a buyer that, hey, we're with you all the way. This is why you have to start the process early. Make sure you shop your lenders, compare rates and costs together. And then there's a process. They're going to come back to you on several occasions to make sure that you have income docs, make sure that you've got your credit report pulled, make sure all these things, and it's subject to the appraisal coming in at value. And we as realtors will walk you through this process as we work with your lender. That's why we need to have their contact information to be able to talk to them. And if things go wrong, we can navigate through this in the process. That's why you should be shopping. So it's good for us to know about sort of the process, what to expect, and when they're approved for different types of loan, we can guess that low down payment, credit score may be an issue, types of property we're looking at. If we have a VA borrower and we're looking at a property that needs tons of work, we may talk to the buyer and say, this property may not appraise or may not be approved by a VA lender. Can you get it qualified any other way? Or maybe we should look for different types of properties. So all things to use in our toolbox to serve our customers. Any questions? Okay. Well, I hope it was worth it today. Have a great long 3-day weekend. I know you're all working, but have a good 3-day weekend, Labor Day weekend. Thank you, guys.